Hello, everyone. Welcome to the ETF Portfolio Partners fourth quarter market review. My name is Nick Romey. I'm the Chief Investment Officer of ETF Portfolio Partners. We've decided to record the market review rather than host a live session, simply because it's easier for people to get on and watch it at their leisure. So with further ado, let's look at what's been happening over the last 3 months of 2024. So in this market review, as always, we're going to go over a brief market update. We'll then discuss current portfolio changes as well as review the portfolio holdings. We'll take a brief look at the economy and where we see things going. And then finally, I'll give some 2025 expectations. Obviously, there's a lot happening with the new administration, so let's get into it. So some key events that happened throughout the fourth quarter. Starting in October, obviously we had challenges when Hurricane Milton hit Florida. The Middle East tensions continued to rise, right? Seeing volatile prices in energy markets and other sectors around that area. And then finally, Goldman Sachs had reduced its 12-month recession probability. Something that probably wasn't talked about as much, but I think if at the beginning of the year you polled market participants and asked whether or not we would have a recession, I think there would be a resounding yes. However, given the strength of the economy, right, GDP has continued to expand, unemployment has continued to fall, the labor market's been very robust. It just didn't come to fruition. And I think going forward, that will be something we'll continue to talk about is, are we heading into a recession? In November, some key events, starting with NVIDIA, right, one of the largest semiconductor manufacturers in the world. This has become a big part of the market as artificial intelligence continues to grow. They joined the Dow Jones Industrial Average. So just a piece of market history, right? NVIDIA is now one of the 30 companies that make up the Dow Jones. The biggest event in November and probably for 2024 was Donald Trump securing his second term in office as president. And then finally, the Federal Reserve decided to lower its benchmark interest rates again by 25 basis points. This is a theme we'll see throughout 2025 as well, right? Will the Fed continue cutting rates? That's going to depend on certain factors that we'll go into later. Another interesting fact is that November was actually the best month for 2024 in terms of stock market performance. Something that you may not have seen, but given President Trump's victory, right, that kind of spurred equities to appreciate, and November ended as the highest month on record for 2024. And then finally, in December, we got some really interesting and positive news in terms of Black Friday shopping, right? We had shopping hitting record highs, especially mobile purchases, showing that consumer demand is still relatively strong, right? People want to go out and spend. That tends to be positive signs for an economy and leads us to believe the economy will continue to grow when you have that strong consumer base. Again, the Federal Reserve lowered their benchmark rate by another 25 basis points. And then what we saw towards the end of the year was, as December closed, we actually ended up with back-to-back 20% consecutive years of market return. Looking at the S&P 500, it's the first time the S&P has gone 20% in 2 years since 1999. So always important to look at in terms of historical market performances, and this is definitely one of those outlier periods. So it was a good time for the stock market. It was a good time for just global equities in general, as we'll get into. And really, that's where we stand heading into the new year. Breaking down U.S. stocks by their size and style, we can see some interesting trends throughout the fourth quarter and the total year. Starting with growth, right? We see growth companies as companies that are focused on plowing their revenue and net income back into the company and hence continuing to grow. A lot of these sectors will include things like technology, consumer electronics, things of that nature, smaller companies. And this really was a story of growth throughout the fourth quarter. As you can see, mega cap technology companies continue to excel. Mega cap growth in general continue to improve, leading the way compared to their value counterparts. And what we know, right, about value companies are they tend to be older companies. They tend to pay a dividend to shareholders in return for them holding those stocks. And they definitely lag behind throughout the fourth quarter. With that being said, it was a good year for all equities, but The trend of large cap and mega cap growth, primarily technology companies, has continued throughout this year. If you look over the last 10 years, technology has continued to grow and become a bigger and bigger piece of the market and a more important component. It essentially drives where the stock market is going on any given day, given how big the sector is. But again, they were the primary benefactors of 2024. As you can see, mega cap and large cap growth excelled, whereas value-based companies, their counterparts, mega cap and large cap value-based companies, still had a really good year, just not as high as those growth counterparts. And you need to take it with a grain of salt. Because these growth stocks tend to be more volatile, right? We're going to see more ups and downs in their price movements compared to value-based companies. But again, technology is leading the way right now in the market, and everyone wants to get in on growth stocks. So in terms of performance, right, broad-based performance for the entire U.S. stock market, whether you break it down by size or style. However, large and mega cap growth companies definitely leading the charge throughout 2024. Looking at foreign stocks, international stock markets, we can see that the fourth quarter was a lot different compared to the U.S. While the U.S. broad-based market increased by 3.7% throughout the fourth quarter, that was definitely not the story for other large developed economies. As you can see, right, countries such as France, United Kingdom, Germany, Japan, they all struggled actually. So the U.S. continues to outperform compared to international companies. If you look on the fourth quarter, the 1 year, the 3 year, the 5 year, all vast outperformances, which is a trend that has continued to take place, right? We've talked before about the U.S.'s dominance in terms of performance compared to international equities, and that's a trend that we believe will continue. I think there are some areas in the market that look relatively attractive in the foreign stock market right now, which we'll get into. But again, for investors, the place to be over the last 5-10 years has been in U.S. equities. There's no doubt about it. And that trend has continued throughout the fourth quarter of 2024. Now turning to fixed income, otherwise known as bonds, it's been a really tough time to be a bond investor. This has continued over the last 3 years. Bonds have been in a bear market for that time period, and right, that what's caused bonds to perform so poorly is the rise in interest rates. We know that when interest rates are going up, the price and returns of bonds will be falling, and that's been the case over the last 3 years, right? The Fed has aggressively been raising interest rates in an attempt to stop inflation, and that's caused bonds to suffer. So what we'll see is that even though bonds on that short and midterm durations have finished 2024 positively, those long-term bonds have continued to lag behind. Should we get any kind of break in interest rates and they begin to fall, we would expect bonds to benefit. If you just look at straight mean reversion, right, bonds have traded well below their mean prices for quite some time. We would expect eventually that mean reversion to happen and bonds to actually outperform for a period. That just has not been the case throughout 2024. A lot of people are optimistic for 2025, but given with inflation right now where it's at, we don't see much price appreciation for bonds in the next year. Hopefully 2026 is different if interest rates can continue to come down. But again, the number one reason why you hold bonds in a portfolio is for the diversification benefit. Should the stock market enter a correction, you would expect to see bonds outperform, right? Investors are leaving risk assets and going into more conservative investments such as bonds. That causes the price of bonds to appreciate. And if you're in a portfolio that's mixed with equities and bonds, that portfolio will perform better than an all-stock portfolio during that correctionary phase. So that's why you hold bonds. But again, a tough year for bond investors, not the return we would have liked to see, especially after the third quarter where bonds showed a really significant turnaround. The fourth quarter reverted course and they suffered negative performances throughout each spectrum, right? Corporate investment grade bonds and government bonds. So it's something we'll continue to monitor. But for now, right, as interest rates continue to rise, bonds will continue to perform poorly. So changing over now to our portfolio review. In early October, one of the things that we did was we rebalanced our portfolios back to their optimal weights. And we also made the decision to go from an overweight value perspective in our portfolio to a more market neutral weighting. That simply just means that we look at the total US stock market and we want to base our style and size segments, right? That growth and value and mega cap, large cap, mid cap, small cap around how the market is currently weighted. And the reason we did this was due to the uncertainty regarding the presidential election, right? We didn't want to be overweight in value or growth because we didn't know how each of those style segments would perform given who won the presidency. So as you can see, this is the ETF Portfolio Partners equity portfolio composition before we rebalanced. We had a slight overweight in value-based companies. And now, as you can see, we've moderated and gotten more market neutral, right? This is a market-weighted portfolio. So really not making any directional calls right now, given where we are. Now, everything could change, should factors present itself. But for the time being, this is a very comfortable position that we plan on remaining in. Again, just looking at that market neutral weighting. So that is the US stock market on the left in gray. And then that is our portfolio on the right in green. As you can see, almost identical in terms of our weightings for value and growth. And then core would just be a blend of the two companies that don't characterize as either a growth or value, right? They're kind of a mix. Looking at international equities in our portfolio, right, we continue to see very cheap valuations compared to US stocks. This has continued to be pronounced as international stocks have underperformed US stocks, right? US stocks are kind of gaining in terms of their valuations, and it's something we've continued to watch. And the other thing that I want to point out is are large firms, large RIAs giving up on international stocks, right? It's an interesting phenomenon because over the last 10 years, if you were to just poll an average investment advisor, an average American's portfolio, they're going to hold roughly 25% of their stock portion in international-based companies. However, we've had clients and we've had people on CNBC, and I've read articles about is now the time to give up on international, right? We've had advisors actually on CNBC saying that they're selling out of international-based companies, and for me, right, as an investor, as a contrarian, I'd like to believe that maybe now is the time to get more into international, right? As people are finally starting to give up on it. That's kind of how it works in the stock market sometimes, right? Sometimes targeting those underperforming asset classes or sectors of an asset class can provide benefit in the future. And so that's something we're continuing to look at and have really dug deeper into for the first half of 2025 is, do we want to have a little more exposure in international stocks simply given their underperformance? And as, right, probably the greatest investor of all time, Warren Buffett, was famously quoted by saying, be fearful when others are greedy, and greedy when others are fearful. Clearly, right now, people are fearful of international-based equities. Now might be the time to look at increasing exposure internationally. And kind of digging into that thought a little more, right? One of the valuation metrics investors look at is something called a PE ratio, a price to earnings ratio. It's essentially how much are you as an investor willing to pay today for $1 of a company's earnings, right? And the higher a PE ratio, the more value or overvalued that company is, or the more you're paying for that $1 of today's earnings. And for an example, right, Ford Motors, if Ford is trading at $10 a share and they have earnings of $2 a share, we would say that price to earnings ratio is 5. Now, looking at the chart, as you can see, the blue line represents the US stock market, the average price to earnings ratio, and then the purple line represents the international stock market and their average price to earnings ratio. What you can see is that as of the end of 2024, PEs are very diverse, right? There's a large gap in terms of valuation metrics. The US has continued to perform, right, thus increasing the price of stocks and not necessarily those earnings, raising the PE ratio and potentially causing some overvaluations. However, international-based companies, right, as the stock market and international has continued to underperform, these PE ratios have become more and more attractive. Another good ratio we look at is the price to book ratio, right? How the market is currently valuing a stock relative to its book value price. And book value just essentially means if you were to liquidate a company, right, take all of its assets, subtract all of its liabilities and debt, how much would that company be worth? And this is a really good metric in terms of valuation because it shows how investors are feeling for a given stock relative to the actual underlying book or tangible value of that company. Again, as you can see, Ford Motors, perfect example, right? Let's say they have a price of, again, $10 and their book value is $5 a share. Their PB ratio would be 2. And again, what we can see is this divergence in price to book ratios for US-based companies and international-based companies. So, right, as Warren Buffett has said, right, be fearful when others are greedy and greedy when others are fearful. Well, now may be a time to be slightly more greedy in international markets because these valuations continue to be very attractive. Something we'll be continuing to monitor throughout the year. And then looking at our fixed income portfolio, as I said before, bonds have continued to struggle. This has been because the Fed has continued to raise their interest rates. Now turning to the fixed income portion of our portfolio, as I mentioned before, bonds have continued to struggle. And what we know is, right, when interest rates fall, the price of bonds should rise. However, with the Fed lowering interest rates throughout the year, the price of bonds has not risen. Market rates have remained elevated. And why is that, right? So the question is, what is keeping rates elevated above that Fed rate? Because the Fed rate is kind of just a rule of thumb, right? They're lowering what they feel their interest rate should be, but ultimately the market is going to determine the actual interest rate. So a couple ideas of what's keeping rates elevated. Number one, inflation persisting longer than expected. We continue to get positive readings in inflation. Inflation continues to grow, likely not to the market's expectations of where inflation should be, signaling that, hey, we may need to keep interest rates elevated for longer than the Fed is telling us right now. Number two, right, the market is expecting or pricing in higher debt in the coming years. What we know is after the first Trump administration, they like to cut federal taxes and increase the amount of freedom in corporations. This tends to lead to less government revenue, right, and increasing government deficit. And in order to finance that increasing deficit, you tend to need higher interest rates. So the market could be pricing in Trump cutting taxes or increasing spending on infrastructure and defense, and thus trying to price in a higher interest rate environment for that presidency. And then finally, a third option is that the Fed may be closer to a neutral rate than once believed. And a neutral rate is essentially an equilibrium interest rate that will allow for unemployment to continue to be relatively stable, inflation to continue to be relatively moderate. And some people believe that, maybe interest rates at this level, right around the 4% level, are good for a healthy economy, right? Maybe there's no need to lower interest rates anymore. And so market bond investors have continued to kind of fight the Fed on this, saying, hey, you're lowering interest rates, but we believe interest rates maybe don't need to be lowered right now. Maybe things are good in the economy. And so that's something that we'll continue to monitor, right? That's a trend. Where are interest rates going to go? So the question everyone asks is, how can interest rates decrease? And again, there are 3 logical scenarios to see lower interest rates in 2025. Number one, inflation is fully sustained, right? It's no longer persistent. If inflation comes down to a point where markets feel that it should, then you'll start to see interest rates creep down as well. Number two, you could see a short-term pullback in equity markets, resulting in a flight to safety, right? As investors leave stocks and buy bonds, that tends to push the level of interest rates down, causing bonds to outperform. It's again what we talked about, that diversification component. And then finally, given a recession or a probability of recession increasing, the Fed could forcibly lower interest rates down due to that market uncertainty, right? If we do get into a prolonged recession, you would expect the Fed to jump in and aggressively lower interest rates like we saw during 2020 with COVID. However, the most logical scenario for how rates can decrease is a short-term market correction or pullback. And the reason we say this is because, right, despite the bond market having a rough go over the last 3 years, investors have continued to move money into bonds. Why is this? Well, they're protecting themselves, right? It's a simple diversification tactic, and what this chart shows is fund flows, cumulative fund flows over the last year. And as you can see, cumulative fund flows for the iShares aggregate bond market, that's just the total US bond market, have continued to go up. So investors are clearly preparing themselves for a possible short-term pullback where bonds do outperform. This is in contrast, right, to the U.S. total stock market in green. So as VTIs continue to outperform, what we see is that investors are taking profits off the table, moving some of their stocks, right, given higher gains, selling out of U.S. stocks, and essentially putting more money into fixed income securities, preparing for that short-term pullback and allocating capital towards bonds. So again, that's why I say don't give up on bonds, because bonds offer that safety component, especially when markets are pulling back or we get into correction territory. And that's why you want to keep bonds in your portfolio. Clearly, the market average is doing the same thing, right? They've continued to pile into bonds, preparing for or hedging themselves for a market pullback. Turning to the economy, again, 2024 was not the story everyone wrote at the beginning of the year. A lot of people thought we were going into a recession. A lot of people thought with the Fed raising interest rates, there's no way unemployment could continue to decrease. They, figured it would actually increase. However, that has just not been the case, right? The labor market resiliency has been one of note for 2024. As you can see at the start of the fourth quarter, unemployment was right around the Fed's target of 4%. It was at 4.2%. And as we ended the year, unemployment has actually continued to fall. So this has been something that, usually doesn't take place. Usually when the Fed is raising interest rates, it causes unemployment to rise, right? Because if you think about it, interest rates are the cost of money. And as the cost of money becomes more and more pricey, corporations start to lay off people. They don't expand. They don't hire new people. However, there's been a very strong demand for jobs throughout the entire year. Another thing that has been a benefit for the economy is inflation. Inflation has continued to decrease, right? So the Fed's been raising interest rates. Inflation's been coming down as it should. It's down 13% since the start of the year. Currently, it's at 2.7%. At the same time, the economy has continued to grow. So we're in a phase right now where the Fed has raised interest rates to stop inflation. It hasn't caused mass unemployment, and yet GDP growth, economic growth for the United States has been positive each of the last 4 quarters of 2024. As you can see, right, our forecasted year-over-year growth was right on target. It was 2.5% for 2024. Currently, market economists are expecting 2025 to be very similar with positive growth, forecasting at around 2% growth for the year. So all things positive in the economy right now. Given that, obviously, we could have an event, some kind of crisis. You look at California right now, that's definitely, a sign of possible turbulence in the economy. But, all things considered, it was a really healthy year for economic growth, for labor markets, for inflation. So looking a little deeper into the Fed and interest rates, right? We've talked about it before. We covered it in the third quarter market review. The Fed has a strict dual mandate set by Congress. And the dual mandate essentially says that the Fed must always try to contain unemployment to roughly around 4% or lower and keep inflation at roughly around 2% or lower. Well, as we just saw, right, unemployment has continued to decrease and stayed at that level. However, inflation is still moderately elevated. And so, right, given all of this, we would expect interest rates to remain at their current level. I don't think interest rates are going to be forced higher by the Fed anytime soon. However, the labor market being so strong is inflationary, right? as more people have jobs and as that job number continues to grow, that's more dollars in consumers' pockets that they're willing to go out and spend. People tend to spend during times of low unemployment, and that becomes inflationary. So that's something to continue to monitor, right? Is that, are we going to have issues with inflation in 2025? The Fed has continued to say they don't think so. Obviously, market investors don't necessarily believe that at this moment, with interest rates staying elevated. However, it's a key metric that we continue to look at, and it's going to affect a lot of things in the economy, in the stock market, in the bond market. So that's where we stand in terms of fourth quarter economic outlooks, right? Pretty good all around. And then finally, looking into 2025, our expectations for the economy, for the stock market. No question, the biggest thing is going to be the new administration, right? Trump's second term in office. And starting off, right, U.S. trade, such a key part of the economy and the stock market. The two big things that come to mind are tariffs and the America First supply chain. Potential implications of this, right? We could see possible heightened trade tensions as Trump either does or threatens to levy tariffs on other countries, particularly China, particularly countries that are exporting energy goods. So what we could see is some increased global volatility as this trade tension or trade war begins to form again, as we saw in 2016. You would expect sectors that are very dependent on cross-border supply chains, right, such as technology because of chips, right, chip makers and semiconductors still becoming a larger focus in artificial intelligence. That could see some issues. Auto manufacturers with those chips again, electronics, energy. So these are all things we're looking out for and potential implications of the second Trump administration. Another thing to look out for, right? Fiscal and tax policy, government spending and taxes. What we are expecting with that second Trump administration is a lower corporate tax rate, right? And heightened spending in infrastructure and defense. It's what he did in 2016. Trump necessarily couldn't get all of the measures done due to Congress being split for half of his term. However, now, right, with Congress in control by the Republicans, you would expect to see more favorable tax measures and spending on these certain segments of the government. Potential implications, right? Tax cuts are favorable for for the stock market in general. Primarily smaller companies, smaller U.S. companies that maybe don't have that wide access as large companies do. They're going to benefit drastically from lower taxes. However, what we know, right, is lower taxes means lower government money, and lower government money or revenue means larger fiscal deficits. That could bring higher interest rates, right, as that cost of financing funds continues to increase, especially if they continue to spend on defense and infrastructure. So again, could be negatives for the bond market, probably positives for the stock market going forward. And then regulatory landscape, right? As with Trump's first term in office, he's going to want to cut regulation, decrease public sector jobs, right, government jobs. And so what we'll probably see is a easing of financial regulations. You'll tend to see more mergers and acquisitions, more initial public offerings happening in the stock market. However, something that's been in the news lately is, right, tech scrutiny, tech monitoring and data surveillance will probably continue to be a big trend going forward. As you know, you see throughout the last several years, right, you have these tech execs testifying in front of Congress. That's probably not going to change. But again, we'll continue to see. Nothing's in place yet. So potential implications for this could be, right, reduced regulations tend to benefit sectors such as banking, energy, consumer finance. However, what we do know is that as the tech scrutiny and tech landscape continues to evolve, that always adds uncertainty and volatility into that kind of major segment of the market, that mega cap and large cap growth. So it'll be interesting to see throughout the first year of Trump's second term what policies and procedures he does put in place and the implication for stocks and bonds going forward. But really, those are kind of the main things right now, right? We're looking at trade and tariffs, supply chains, fiscal and tax policy, and then finally regulatory landscapes, trying to figure out where 2025 shapes up. But in terms of just economic health, in terms of stock market momentum, all things are positive right now, and we continue to believe that the bull market will progress throughout 2025. I don't think we see a correction or a bear market in 2025, given everything that's in place. So to wrap things up, the fourth quarter continued to be a really positive quarter for the market. 2024 ended really good for the stock market, the bond market. We continue to monitor. But again, as investors, it's easy to get caught up in these short-term swings and all these news events. But in reality, the long-term investor with a long-term strategy is going to be the one to succeed. Don't let short-term fluctuations and events change your long-term trajectory. Don't let it change that strategy. So with that, I want to thank you for your time. Let me know if you have any questions. If you would like to receive this slide deck in a PDF version, we're happy to send it to you. So thanks, everyone. Take care.